The stock market crash of 1929 was a catastrophic event that sent shockwaves through the United States and ultimately led to the Great Depression. It marked the beginning of the most severe economic downturn in modern history. The crash occurred on October 29th, known as Black Tuesday, when the stock market experienced a sudden and dramatic collapse. The effects were immediate and far-reaching, causing widespread panic and devastating financial consequences for individuals, businesses, and the economy as a whole. In the years leading up to the crash, the stock market had experienced rapid growth and speculation. Many individuals and even banks invested heavily in stocks, often buying on margin, a practice that allowed investors to purchase stocks with only a fraction of the total cost. As stock prices soared to unprecedented heights, people became increasingly optimistic and believed that the market would continue to rise indefinitely. However, this optimism was built on shaky foundations, as the market became detached from the underlying strength of the economy. The crash itself was triggered by a series of events that revealed the underlying weaknesses of the stock market. One of the key factors was the excessive speculation and the overvaluation of stocks. As investors began to realize that prices were artificially inflated and unsustainable, panic set in. Selling frenzy ensued as people rushed to get rid of their shares, causing a rapid decline in prices. The lack of regulation and oversight in the market further exacerbated the situation, as there were no mechanisms in place to control the downward spiral. The crash had immediate and severe consequences for the economy. Billions of dollars were wiped out in a matter of hours, leading to a massive loss of wealth for investors. Many individuals, including ordinary Americans, had invested their life savings in the stock market, and overnight they found themselves destitute. The collapse of the stock market had a cascading effect on the broader economy. Banks and financial institutions collapsed as they had invested heavily in stocks and faced insurmountable losses. This resulted in a severe credit crunch, making it difficult for businesses and individuals to access loans and credit. As the effects of the crash reverberated throughout the economy, mass unemployment ensued. Millions of people lost their jobs as businesses went bankrupt or drastically cut back their operations. The unemployment rate skyrocketed, reaching a staggering 25% at its peak. People struggled to make ends meet, leading to widespread poverty and destitution. The Great Depression had set in, and its grip on the nation was relentless. The stock market crash of 1929 highlighted significant flaws in the financial system and brought about lasting changes in regulation and government intervention. The crash exposed the dangers of unbridled speculation and the need for oversight in the stock market. In response, the U.S. government implemented a range of reforms to prevent a similar crisis from occurring in the future. The most notable of these measures was the establishment of the Securities and Exchange Commission, SEC, in 1934, which aimed to regulate the stock market and protect investors from fraudulent practices. The lessons learned from the crash and the subsequent Great Depression shaped economic policies and theories for decades to come. The belief in the self-regulating and infallible nature of free markets was shattered, leading to a re-evaluation of the role of government in the economy. The concept of Keynesian economics gained prominence, advocating for increased government spending and intervention to stimulate economic growth and prevent future crises. The crash and the Great Depression also underscored the importance of financial literacy and responsible investment practices, emphasizing the need for individuals to make informed decisions and diversify their investments.
In conclusion, the stock market crash of 1929 stands as a pivotal moment in history that triggered the Great Depression.
Its impact reverberated far beyond the financial sector, causing widespread devastation and fundamentally altering the course of the nation. The crash exposed the dangers of speculative excess, the fragility of the financial system, and the need for government intervention. The lessons learned from this catastrophic event continue to shape economic policies and practices, serving as a stark reminder of the importance of prudence, oversight, and responsible decision-making in the world of finance and beyond.